Peachtree Securities Incorporated, Case A, by Ryan Porto. The T-bond is shown to be independent of the state of the economy because it is free from default risk and market risk as it has a locked-in yield to maturity. The United States Treasury borrows money for operations, bringing a stated par value to the investors at expiration. The one-year T-bond is not free from reinvestment risk, meaning upon expiration the investor may not be able to reinvest at an equal rate as the T-bond. Inflation risk also occurs, as a change in inflation will impact the real return on the T-bond. The real return on an asset is the nominal rate minus the inflation rate. This means that a change in inflation will change the real rate of return for the asset. Okay, next slide. The expected return for each of the assets calculated by summing the weighted returns based upon the standard deviation and coefficient of variation are a measurement of total risk and volatility of an asset. In particular, they are measurements of systematic and unsystematic risk. Standard deviation and coefficient of variation measure the variability of return based upon market conditions as well as other risks. Therefore, the lesser the standard deviation and coefficient of variation, the less variability from the expected return. Coefficient of variation measures this variability in terms of expected return. As seen, the standard deviation and coefficient of variations for T-bond are 0. The standard deviations for TICO is 11.72%, Gold Hill 9.09%, and the S&P 500 at 16.43%. The coefficients for variations for those assets are 86.79% TICO, 103.25% Gold Hill, and 109.55% for the S&P 500. Coefficient of variation is a better measurement when comparing multiple assets, because it compares the deviation of the assets as compared to each mean return. If the expected return is greater for an asset, the coefficient of variation diminishes the risk slightly of the asset so that it measures risk as a comparison of expected return. Because each asset has a different mean return, the standard deviation may not accurately represent the risk and gains, but just the volatility and deviation from mean return. Standard deviation is a better measure of single assets as they are more prone to risk, which is not diminished by expected return. The portfolio return for an equally weighted portfolio of TICO and Gold Hill is 11.15%, has a variance of 0.084%, a standard deviation of 2.89%, and a coefficient of variation of 25.92%. Even with a very limited amount of diversification, the effects of holding multiple assets is already beginning to show through, as the standard deviation of the portfolio is far less than that of the individual assets. While the mean return of the portfolio may not be as great as TICO's, it does, however, decrease the risk of variance of returns. This can also be seen in the coefficient of variation, which measures the variation of an asset as compared to return, as the 26% coefficient of variation of the portfolio is far less than 87% for TICO and 103% for Gold Hill. TICO and Gold Hill correlate together inversely, meaning that as the market goes into recession, the expected returns for Gold Hill will increase, and if the market booms, then TICO would see an increase in expected return. And a negative 87.55% correlation proves an inverse relationship of the assets. Therefore, the two assets essentially hedge the portfolio as the investor is better protected for a myriad of market environments. The negative correlation proves an inverse relationship, and as the two assets correlate inversely near 90%, therefore they balance themselves fairly well when weighted equally, and skewing the weights heavily in favor of one stock diminishes the ability of the asset to protect the investor from market changes, as seen on the chart, in which the modification of the portfolio takes the weight of 75% TICO and 25% Gold Hill, and then also 25% TICO. On a two-asset portfolio of TICO and S&P equally weighted, the expected return is 14.25%, has a standard deviation of 14.06%, a coefficient of variation of 98.67%, and a correlation of 99.74%. As seen, the positive correlation that is nearly 100% shows that these assets move together and do not protect the investor from a myriad of market conditions. While the standard deviation does decrease when compared to the single asset of S&P 500, it actually increases the variability when compared to TICO by itself. The standard deviation of the portfolio would decrease if more randomly selected stocks were added to the portfolio. However, the expected return would remain relatively constant. This is because the practice of increasing the different assets of the portfolio would lower unsystematic risk, due to each stock not being perfectly correlated. The stocks may not correlate inversely, therefore they may not dramatically reduce variation, while still reducing unsystematic risk. Diversification of assets allows for investors to decrease unsystematic risk while not majorly affecting the expected return. Therefore, the diversifying of assets helps to shield the investor from asset-specific risk, all while bringing about a more secured return. Cost of capital is also affected by diversification because risk aversion becomes less significant and therefore investors will require a lesser rate of return on equity. This decreases the cost of capital for the company as cost of equity is reduced. Portfolio diversification should impact investors' views of risk because, if well diversified, they should not concern themselves with the standard deviation as this represents diversifiable risk. Instead, investors of individual stocks worry about the variation from mean return as they are more exposed to the unsystematic risk of an individual asset. That being said, an investor that is well diversified should concern themselves more with the impact that this asset will have on the portfolio and the remaining undiversifiable or market risk. Market risk is the systematic risk of investing in the market. Diversification cannot rid the investor from such risk. Diversifiable risk or unsystematic risk can be alleviated or even removed in a well-diversified portfolio. This risk relies heavily on aspects such as company performance and outlook, as this risk applies to a specific asset. Total risk, in turn, is a combination of all risks, including systematic and unsystematic risk. One should not assume to be rewarded for not diversifying risk because other diversified investors would buy the stock at a bargain as they have diversified away unsystematic risk. Therefore, other investors would buy the stock, driving up the price and diminishing the exceptional return. So market price exists for investors that have already diversified their portfolio to the point that they have diminished diversifiable risk. On the plotted graph, each point on the colored lines represents returns of each asset as returns change of the S&P, and the lines themselves are trend lines in existence for the viewer to better see the change in return. As seen in the legend of the graph, each asset is color-coded with the T-bond being in blue, TECO in red, and Gold Hill in green. The black lines are the linear regression of each asset in order to draw upon a calculated change in return for the S&P. The slope of each line represents the beta of the asset. The T-bond does not have a slope as its return is unaffected by change in market and therefore remains at 0.08% return, or 8% return, or as shown in the equation y equals 0.08. TICO moves with the S&P as it shows a positive beta with a slope of 0.7. The closer the slope approaches to 1, the more closely the assets represents the market. Finally, Gold Hill has a negative trending linear regression as represented by its slope of negative 0.39. Its negative correlation to the market shows the reason in which the asset is such an effective tool for decreasing the deviation from expected returns when paired with the assets such as TICO. When the return trend line deviates from the linear regression line, shows the error of the model. The greater the gaps between these lines, the less valid the model is as a representation of the returns as they compare to changes to the return of the S&P. The security market line graphs the expected return of TICO based upon a change in beta, in which the y-axis represents the return and the x-axis represents the beta. The blue line represents the expected value of TICO as beta changes, and the red point represents the 13.5% expected return as calculated above. As shown with the volatility of the stock, one can see at 0.6 beta the expected return of TICO is greater than that of calculated. Therefore, TICO shares may be undervalued. Okay. The capital asset pricing model projects that a change in the risk-free rate from 8% to 11% would change the required rate of return to 13.4% as compared to the prior rate of 12.2%. A change in the risk-free rate changes the required rate of return, meaning a rise in the risk-free rate would put upward pressure on the required return of the asset. An increase in risk aversion would mean that the return of the asset would contain a higher risk premium to reward investors for taking on risk. If investor appetite for risk decreased and caused the market risk premium to increase from 7% to 8%, CAPM projects that new expected rate of return would be 12.8% when the risk-free rate is at 8%. In like inflationary conditions, this increase in risk aversion would increase the required rate of return by 0.6%. An increase in beta to 1 from 0.6 under original market conditions would increase the required rate of return to 15%. Beta represents the volatility of the asset as compared to the market. Therefore, a beta of 1.5 is 50% more volatile than the market, thus justifying the higher risk premium. The efficient market of hypothesis states that the market is always accurately priced, as a change in information will cause immediate change in prices. Under this theory, the concept of an undervalued or overvalued asset cannot exist. This being said, one cannot outperform the market, as all prices are accurate at all times, and adjust in response to the market as well as when new information is available. Corporate financing decisions should be impacted by EMH because corporations would look to rid themselves of diversifiable risk, such as General Electric. General Electric is so diversified that their stock itself is really free from much diversifiable risk. Also, corporations are able to have a lower required rate of return on their equity due to an increase in diversifiable risk. Jake should concern himself with EMH when he considers adding to his staff of security analysts because Jake should concern himself instead with creating a well-diversified portfolio and not adding staff that is going to look for undervalued assets. From this theory, it is more important to diminish unsystemic risk through diversification in order to achieve The efficient market of hypothesis states that the market is always accurately priced, as a change in information will cause immediate change in prices. Under this theory, the concept of an undervalued or overvalued asset cannot exist. This being said, one cannot outperform the market, as all prices are accurate at all times, and adjust in response to the market as well as when new information is available. Corporate financing decisions would be impacted by EMH because corporations would look to rid themselves of diversifiable risk, such as General Electric. General Electric is so diversified that their stock itself is really free from much diversifiable risk. Also, corporations are able to have a required rate of return on their equity due to a decrease in diversifiable risk. Jake should concern himself with EMH when he considers adding to his staff of security analysts because Jake should concern himself instead with creating a well-diversified portfolio and not adding staff that is going to look for undervalued assets. From this theory, it is more important to diminish unsystemic risk through diversification in order to achieve an efficient market return. A decrease in long-term debt ratio would decrease the volatility of the stock. Therefore, the required rate of return for the stock would be less as risk is less. Debt increases the likelihood of default risk, therefore creates an increase in required rate of return due to greater risk premium. So a decrease in debt ratio would decrease the volatility of the stock, thus decrease beta, as well as decrease the required rate of return. This concludes my presentation.